Welcome to this Nedbank Financial Market Educational Series, proudly brought to you by our online share trading division. Throughout this educational series, we will discuss various topics related to financial markets. Learning about trading and investing is essential for every client, as this will equip you to make more informed personal trading and investing decisions. As a client, you want to make money. However, there is more to this than meets the eye. In this session, we will discuss derivatives. Derivatives are one of the three main categories of financial instruments, the other two being equity and debt. As a result, the concept of derivatives is something every trader will need to understand. We'll start with the definition of what a derivative is, and then we will progress into the different types of derivatives. We will look at the advantages and disadvantages, and we will finish the session with how derivatives can be used. Please note that this session is on both an intermediate and an advanced trader level. Before we start, please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice, as this information is provided for educational purposes only. Let us start this session by defining what are derivatives. A derivative is a contract between two parties, which derives its value or price from another security. The other security is referred to as an underlying asset. The underlying assets can consist of one security or a combination of different securities, and can be any other financial instrument such as equities, bonds, currencies, commodities, and interest rates. The derivative contract is traded as its own financial instrument. The value of the derivative financial instrument is determined by the value or price of the underlying assets. The value of these underlying assets is expected to change as market movements happen. The most common types of derivatives are futures, options, forwards, and swaps. Some derivative contracts, such as options and futures, are traded on specialized exchanges, but most derivatives are traded over the counter. Over the counter, or OTC, refers to securities that are traded via a broker-dealer network as opposed to on a centralized exchange. Let's take a quick look at a brief history of the derivatives market. Derivatives are not a contemporary financial implementation. For example, the exposure of the first futures contracts can be traced back to the 2nd millennium BC in Mesopotamia. However, the financial implementation was not widely used until the 1970s, when the establishment of new price techniques kindled the prompt development of the derivatives market. Nowadays, we cannot imagine modern finance without derivatives. The derivatives market these days. The derivatives market is enormous. It is estimated to be worth around $1.2 quadrillion. The reason why it is so large is that derivatives can be created for many different assets, including bonds, equities, commodities, currencies, etc. Many more experienced investors prefer to buy derivatives rather than buying the underlying asset. The derivatives market is divided into two categories: over-the-counter, or OTC derivatives, and exchange-based derivatives. OTC, or over-the-counter derivatives, are derivatives that are not listed on exchanges and are traded directly between parties. This type of derivative is extremely popular amongst investment banks. Exchange-based derivatives are ones that are listed on exchanges, such as the South African Futures Exchange, or SAFEX. Clients such as commercial banks, hedge funds, and government-sponsored enterprises frequently buy OTC derivatives from the investment banks. It is common for large institutional investors to use OTC derivatives and for smaller individual investors to use exchange-based derivatives for trades. Let us now discuss the participants in the derivatives market. The participants in the derivatives market can be broadly categorized into four groups. Firstly, the hedgers. Hedging is when a person trades or invests in financial markets to reduce the risk of price volatility in exchange markets, i.e., eliminate the risk of future price movements. Derivatives are the most popular instruments in the sphere of hedging. This is because derivatives are effective in offsetting risk with their respective underlying assets. Secondly, speculators. Speculation is the most common market activity that traders engage in. It is one of the high-risk activities in the financial markets. It involves the purchase of any financial instrument or asset that the investor speculates will become significantly more valuable in the future. Speculation is driven by the motive of potentially earning lucrative profits in the future. Thirdly, arbitrageurs. Arbitrage is a very common profit-making activity in financial markets. Arbitrage is the process of simultaneous buying and selling an asset across different platforms, exchanges, or locations to cash in on the price difference that can result from the price volatility of the asset. Arbitrageurs make a profit from these small price differences across various financial instruments such as bonds, equities, derivatives, etc. Lastly, margin traders. Margin trading is when you buy and sell assets of other types of investments with borrowed money. In technical terms, margin is the collateral deposited by a trader or investor investing in a financial instrument to the counterparty to cover the credit risk associated with the investment. Now let's look at the different types of derivatives. There are 4 basic types of derivative contracts. These include futures or forward contracts options and swaps. Forwards and futures. Both forward and futures contracts involve the agreement to buy or sell a commodity at a set price in the future, but there are slight differences between the two. While a forward contract does not trade on an exchange, a futures contract does. Settlement for the forward contract takes place at the end of the contract, while the futures contract settles on a daily basis. Most importantly, forward contracts can be customized between the counterparties, whereas futures contracts exist as a standardized contracts that are not customized between counterparties. The second type of derivatives are options. An option is a contract giving the buyer the right, but not the obligation, to purchase or sell the underlying asset at a pre-agreed price. Based on the option type, the buyer can exercise the option either on the maturity date, which is known as a European option, or any date before the maturity, which is known as an American option. There are 2 types of options: put options and call options. A call option provides the right to purchase an asset at a set price, whereas a put option provides the right to sell an asset for a set price. Thirdly, there are swaps. Swaps are derivative contracts that allow the exchange of cash flows between 2 parties. The swaps usually involve the exchange of a fixed cash flow for a floating cash flow. The most popular types of swaps are interest rate swaps, commodity swaps, and currency swaps. Lastly, we have contract for difference, CFDs. A CFD is a financial contract that pays the differences in the settlement price between opening and closing trades. CFDs essentially allow traders to trade the direction of the underlying asset over the very short term, and are especially popular in equities, forex, and commodities products. So what are the advantages of derivatives? They can provide predictability, and as a result, derivatives can play a significant role in modern finance. They provide numerous advantages to the financial markets. Firstly, derivatives are used for hedging risk exposure. Because the value of the derivatives is connected to the value of the underlying asset, the contracts are primarily used for hedging risks. For instance, a trader may purchase a derivative contract whose value moves in the opposite direction to the value of an asset the trader owns for longer term. In this case, profits in the derivative contract may nullify losses in the underlying asset. Secondly, underlying asset price determination. Derivatives are often used to establish the price of an underlying asset. For instance, the spot prices of the futures can serve as a prediction of a commodity price. Thirdly, market efficiency. The use of derivatives increases the efficiency of financial markets. By using derivative contracts, one can duplicate the payoff of the assets. Therefore, the prices of the underlying asset and the associated derivative tend to remain in the equilibrium, reducing arbitrage opportunities. Lastly, access to unavailable assets or markets. Derivatives can help organizations get access to otherwise unavailable assets or markets. By employing interest rate swaps, a company may obtain a more favorable interest rate relative to interest rates available from direct borrowing. Then what are the disadvantages of derivatives? Despite the benefits that derivatives bring to the financial markets, they also come with some significant drawbacks. Derivatives played a major role in the global financial crisis of 2007 and 2008. The rapid devaluation of mortgage-backed securities and credit default swaps led to the collapse of financial institutions and securities around the world. The first thing we need to acknowledge about derivatives is that they are a high-risk instrument. The high volatility of derivatives exposes them to the potential of huge losses. In addition, the sophisticated design of the contracts makes their valuation extremely complicated or even impossible for many investors. Thus, derivatives also bear a high inherent risk. Then, there are speculative aspects. Derivatives are widely regarded as a tool of speculation. Due to the extremely risky nature of derivatives and their unpredictable behavior, ill-considered or irresponsible speculation may lead to huge losses. Thirdly, there is the counterparty risk. Derivatives traded on the exchanges normally undergo a thorough due diligence process. However, many of the contracts traded over the counter do not include a benchmark for due diligence. Thus, there is a possibility of counterparty default. Lastly, let us conclude with using derivatives for risk management. Although derivatives are used for speculation, they are also used for risk management. Many parties use derivatives to make sure that they do not experience unfavorable price movements in the near future. For example, maize manufacturer may buy grain futures at a certain price to make sure that the company will be able to afford to purchase the maize a few months down the line. This protects the maize manufacturer from being caught in the position where it cannot afford to buy the maize it needs, if the price of the maize rises too much in the near future. Keep in mind that speculation involves trying to make a profit from an asset's price change, whereas hedging attempts to reduce the amount of risk or volatility associated with an asset's price change. Hedging attempts to reduce the impact of the volatility associated with the price of an asset by taking offsetting positions in it. In other words, a position contrary to what the trader or investor currently has. Whereas the main purpose of speculation is to profit from betting on which direction the price of an asset will be moving. We have come to the end of this session. This educational video was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.